Good morning, Zinger Nation. Welcome to another episode of Benzinga Live. I'm joined by my man today, Ryan Pannell. He's hanging out backstage. We're going to be continuing our great conversation about the DIP ETF and more generally about AI on Wall Street. I mean, I've said it before, I'll say it again. It's been the story of 2023. We've been watching NVIDIA's price action this week as the stock gets ready to head into earnings. Trading down a little bit this morning after the stock opened at like new all-time highs. Again, this is off the heels of some increased demand for NVIDIA's products and chips ahead of the company's earnings on Thursday, all driven by AI. And we've got the man to talk to hanging out backstage. Ryan Pannell has a very interesting, kind of intersection of knowledge between both artificial intelligence and finance, which makes him really the perfect person to talk to. Of course, Kaiju ETFs is running this DIP ETF, which is managed by an AI, but I don't want to explain too much about it because I've got Ryan backstage who will do a much better job. So let's go ahead and give Ryan our little intro, and we come back. We'll be talking some more AI. What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Ryan, how are you doing today?
Good. How you doing, Aaron?
Good. You have a good weekend and Monday and everything?
Yeah, pretty restful. I mean, we had some wildfire smoke that blew through, and that choked things up a little bit. But I think that's where everybody has been this summer, frankly.
Yeah, a lot of smoke, a lot of weird weather, certainly this summer. I mean, hopefully that's not just like the new normal, is that every year we're going to get more and more, natural disasters and weird weather patterns, but it kind of seems like that's where we're headed.
Yeah, fingers crossed, right?
Yep. And then yesterday, I mean, was a Monday, but I was talking here on Benzinga. It didn't, I mean, in terms of Mondays, it felt like a pretty good Monday, at least if you were long tech or long the general market. The S&P 500, the NASDAQ composite each finished up more than 1%, which, might not be, sound like the best, but over the past few weeks where there's been a lot of red, it certainly felt good.
Yeah, green morning as well across the board today, generally. So that's it's always a nice way to start your day, right?
Yes, sir. All right. Well, Ryan, let's get into it. And before we start, just again, in case there are any new viewers with us today, you want to give us just a general overview of Kaiju and of the DIP ETF?
Sure. So globally, Kaiju is an ecosystem of companies that have been working in AI for a long time, at least by current standards. And we build AI curated and directed trading strategies for private funds that we run on the private side. And then just last year, we launched Kaiju ETF Advisors, which is pushing those strategies that are appropriate in the 40 Act space out to the broader investing public via ETFs. And the DIP ETF is our flagship ETF. It's designed to capture low to high mean reversion in S&P 500 components, uses some weighted large cap indexes as well when it needs to. And we really designed it for investors that like the strategy, of buying the dip, but had sporadic performance with it. They were identifying some authentic dips and misidentifying others. So we thought, all right, why don't we just, build an AI around finding authentic dips and push that out to the marketplace. So if you like that strategy, this is an easier way to do it. And it's something that AI does well. AI doesn't do everything well, as we've talked about many times, Aaron, but these types of patterns, it tends to do well.
Yeah. So, I'm curious, backing up from the DIP ETF and just talking about Kaiju in general. I mean, do you guys have a particular philosophy or vision that drives you and what you guys are doing? I mean, I know it's hard enough to get staff to buy into this type of company vision, let alone an AI algorithm. So what are kind of these, philosophies that drive Kaiju?
Yeah, I mean, if I had to sum it up, the term that we've been trying to use recently is responsible AI, right? Because with this explosion that's happened over the last 8 months, you have shops like ours that have been using this for like half a decade, and then you have all kinds of new players that have rapidly entered the space. I mean, you've seen AI applied, that term applied to apps in the App Store that are not using AI. You've seen it applied to like light bulbs that you can buy in the hardware store. Now with an AI layer, so it's how do you separate yourself from getting tossed in the bucket with all the hype? And from our perspective, it's always been responsible AI. What do I mean by that? I mean that just because AI can do something doesn't mean we use it for that, and certainly doesn't mean we let it run wild, right? I mean, there are a lot of guardrails we place on it. That often comes at the expense of nose bleeding performance, which you can get with black box AI directed strategies, but you can also get like a 90% drawdown, and nobody wants that. So instead of just looking at the mountain peak, it's like the route there. And I think that is something that's widely embraced internally at the company. And then obviously the glue that holds everyone together here is the belief in the usefulness of this technology. Like, it's not just AI for AI's sake. It's like, let it do some heavy lifting for you so that you can focus on things that it doesn't do well. If you're focusing on everything, you're not really getting a break. If you let AI do some heavy lifting for you, okay, fine. I'll let it be responsible for all the technical trading that we do. Great, super. So you can look at global macro, you can look at earns plays, you can work in these spaces that AI is not very good at forecasting or working in.
Yeah, and I think that makes a lot of sense. And the way you put it, Ryan, is that AI is good at some things, not great at all things, at least not yet. But I mean, so the underlying strategy of dip is to buy the dip. Is there something particular about AI that makes this strategy something that it does, that the AI does effectively? Do you foresee a point in the future that the AI will eventually be like a black box type thing where it's creating its own strategy and you guys are more hands off?
Um, the shorter answer is not really. What makes buying the dip a good strategy for AI is that, I mean, let's back up and just say we're talking about artificial dips, right? Artificially oversold conditions, we call them, right? It's not every pullback, and this is what investors struggle with, right? Every time a stock sells off is not necessarily a buying opportunity. That could be the mean reversion. It's hugely overspeculated, it's overvalued, reality settles in, and it comes back to its fair market value. And it may stay there or drop lower. It may be rolling off a high because of fundamental problems with the company or its leadership. So there's good reasons for a lot of the pullbacks, but some of them are large institutional players, I should say, caused by large institutional players that are predating on specific liquidity opportunities. So there's, the spread blows out, there's low liquidity, and there's an opportunity for like an HFT to hit a stock like a freight train. You look at Chipotle intraday, you got a huge global company, but intraday it can be pretty illiquid. ISRG, same thing, pretty illiquid during the day. And these are monster companies. And so someone can hit that, artificially depress the stock, cover lower, buy back, buy in, whatever. Eventually, it's going to hit an institutional buy zone that will absorb all that flow and send it back up. And so there's a pattern there that you can look for. And that's it, right? Like we're not buying and then we're holding for the next 3 months. We're buying and we're holding for 1 to 7 days, right? We're just capturing this little piece of price action over and over again. So it's really good at doing that. In terms of where it goes in the future, yeah, there's a machine learning layer there. You look at like the last 30 days of its performance, and we've been asked repeatedly, including on your show a couple weeks ago, like, what is that? That's machine learning in real time, right? And so the power of AI is exhibited right there, but it's still working within this rules framework. Yes, it's able to rewrite part of its code to optimize how it picks these dips, how it identifies them, the weighting of the criteria that it uses. It can adjust that, but it can't just decide to go do something else, which is why, when we were asked by the Wall Street Journal recently, like why it didn't pick the specific stocks for the big AI tech boost in the spring. Well, none of them were in dips, and it's not designed as a Momo algorithm. It's designed to find dips. So it's going to keep doing that. So black box, no. Optimization and increased efficiency, yeah, absolutely.
Got it. That makes a lot of sense, Ryan. So I understand that you spent some time briefly, some years ago, as a retail trader before becoming a professional trader, and then fund manager, and now the global chair of Kaiju. I'm curious, what were like the things that you learned mentally, kind of some of the psychological, tricks as a retail trader? Like, did you bring
Yeah, I think the big shift for me was in the mental game, right? I mean, you start out and you're thinking about, how am I going to make money? And the lack of information out there is pretty shocking, right? What do you have? You have chat rooms, you've got some blogs, not access to quality information. You don't, when you're starting out, you don't really know any professional traders. If you do, they wouldn't really talk to you about how they run their businesses. So, it can be a question of the blind leading the blind. And uh, for me, the biggest shift was starting to learn, from some kind traders, starting to learn that it was possible to increase performance just based on rules, application of rules. That's the biggest difference. I like everybody else thought that there were tools that were needed. I didn't have the right software. I didn't have the right broker. I didn't have that. But that's not the case. Really, what it came down to was the mental game and understanding the standardization of capital deployment, across your strategies, so that you weren't like investing based on emotion. I like this one, I'll invest more. I don't like this one, or I'm worried, I'll invest less, et cetera, et cetera. Um, and so applying that, number one, we've talked about that before, and really realizing that you needed to let the law of large numbers and probable outcomes work for you. So the more you cherry pick, the more you skew based on an emotional read, the more you pick and choose within like a series of possible candidates that you feel really strongly about, the more you're going to randomize your outcomes. And then you're going to feel that like as a trader. You might have periods where you're just on fire, and then periods where you're like, I can't do anything right. And that can be really difficult. And so going that systematized trading route makes all the difference in the world. Really, that's where I came at it from.
Got it. And Ryan, I'm here with the audio only. We had our camera froze up, so we're getting that restarted right now. But I'm here with you. So as we kind of wrap up today and head toward the Kaiju kicker, before we get there, I want to ask kind of a follow-up question on your point there. So, what are some of the things, I guess, that as retail traders, like things that we can kind of take from a professional strategy and try to implement in our trading?
So, as I think we talked about it, maybe last show, maybe the show before that. Um, you know, the easiest ways to see an increase in performance are, as I just said, standardize your allocation across all your trades. Because if it's standardized, it's going to highlight the areas in which you're making good decisions and you're not, because you're probably not just trading one strategy, right? You've got a handful that you like. You're looking for specific signals. I don't know if you're using indicators to help you identify these signals, but you know if you are standardized across all of them, if all of your bets are the same, whatever it is, $50, $100, doesn't matter, then you can identify signals that are working for you and signals that are not. And that leads into take notes. Like, I don't know any professional traders that don't keep, I mean, we have to do it for regulatory purposes, but you want to make a note. Most analytics software, certainly, I mean, you can use Notepad or you can use Notes if you're on a Mac. Like, make notes on why you picked this stock, why you executed this trade. Saw this looked good, feel good about that, got this here, did my homework, etc. And then you need to go back and review those and see whether or not there's consistency in the wins or losses. Like when you lose, is there something you keep seeing that doesn't pan out that you think will? And that's a really important part of it. And finally, you need to trade every opportunity, right? Again, if you see 20 opportunities and your position size is too large, and I can't say it enough, small position sizes, small and more of them. So if you keep your position sizes small, you can trade as much as you can within what you're seeing from an opportunity perspective. Then you're going to be picking like the whole cohort instead of a subset, because it's totally possible that out of 50 opportunities that you're evaluating and you decide you're going to trade 10, you could easily accidentally randomly pick the 10 losers, 40 winners, which means you're awesome, but you picked the 10 losers. And that's tough for a trader to take on. It's like, oh, I pick all the losers. Okay, so stop doing that. Within your strategy, with a collection of strategies, you have a number of opportunities, trade all of them, and then let the law of large numbers work for you. Fine, you'll have the 10 losers and you'll have the 40 winners. And if you have your asymmetrical return on risk, you'll make money right there. It's mental. It's not tools. It's not access to information. It's just rules and discipline, really.
Got it. Well, I'm going to turn it over to the chat to see if we've got any questions from our audience today, in general about Kaiju, about the DIP ETF. But Ryan, for the Kaiju kicker, I was thinking we can, do a quick review over some different tools and whatnot that for us retail traders to use in terms of what you use for charting and analytics softwares. What's the most important things to consider for a broker? How much money do you really need to start with if you want to make some money trading? And do you prefer maybe and explain this one out, but options versus common stock, especially for maybe a retail trader?
You pick like a highlight reel there. That's a lot to sort of blast through, but I'll do
I
my
know,
best.
We'll do rapid fire.
Rapid fire. I'll do my best to answer those without boring people to death. Okay, so first one, analytics package. We use a number of different packages, obviously here. If I had to pick a general package, and again, caveat, I'm not compensated by saying this in any way. TC2000 Worden is, I don't actually know how they make money. It's a monster package for what it is. It doesn't cost very much money. It has real-time data. I think they even have a brokerage now. I think they clear with Apex. So it can be like a one-stop solution. But from an analytics package, it's the one retail package that a lot of professional traders use. It allows you to make sure your candlestick charts are black and white on a white background, which we talked about before is so important. Please don't trade red and green candlesticks on a black background unless you like being 30% less profitable. Your brain is just not trained to read those patterns. It has really powerful scans built in and that you can create and customize. And it has a PCF module, so you can write your own indicators and then layer that under a chart. So it's like shockingly powerful. I would go that route. So there's your trading software. What to look for in a broker? I mean, everyone's going to say commission fees and should say commissions and fees. And from my perspective, inventory, right? Access to borrows. If you're only trading the long side, you're trading like half the market, and it will be harder for you to make money in all market conditions. Learning how to short, when to short, what are the strengths, pros and cons of shorting is one thing, but you also need the borrows, right? It's not your stock. So you have to have access to the stock to borrow it and short it. And some brokers have access to crummy inventory and others have great inventory. I don't know if IB still has the best short inventory, but they used to. That was sort of a go-to. On the how much money do you need to make money in trading? Okay, I've been asked this about 1,000 times in my career. I guess it's a popular question. So the short answer is, if you're just starting trading, you really don't need any money. Something like TC2000 or your brokerage account probably has a paper trading account. And I can't stress this enough. You should paper trade whatever strategy you think you're going to do for a minimum of 6 months before you put live cash on it. If you are not profitable after 6 months of paper trading, there's something fundamentally wrong with your strategy, and best that you don't lose your hard-earned money over it. If you can't exercise the discipline to paper trade 6 months, I'm sorry to say this, but you don't have the discipline to be a professional trader. I mean, like, that's the minimum, right? Patience, 6 months of paper trading, you're profitable, let her rip. So you don't have to have any. When you're starting, you got the different tiers. You could start with, a couple grand, whatever your broker will let you open an account with. Some of the prosumer brokers like IB, I think it's a $15,000 minimum. Okay, so you have that. You're going to have a hard time with position sizing. Fractional trading is an option. I'm not a huge fan. That's a subject for another episode. But you're then going to fall into the tier of pattern day trader, right? So you have this round trip trade limitation under whatever it is, $25,000, $26,000. Where you are going to be restricted to the number of round trip trades you can do a week. And that's going to limit you to the type of trading you do. So swing and momentum trading will be really difficult if you only have 5 of those puppies during a week. You're probably going to start with more position trading, right? You're quarter on quarter there. If you can be over $25,000, you'll skip the PDT rule and you're off into regular trading. But your Reg T margin, which means you're going to have less capital efficiency than if you were over 100 grand and you have access to portfolio margin. Again, better calculations, better leverage, topic for another day. So short answer, you don't need anything to start and determine whether or not this is something that's going to work for you. And there is a way to work with each capital level. Your last question, I think, was stock versus options.
You got a good memory.
Yeah, well, I probably would not be very good at this job if I didn't have a good memory. That's a key skill right there. You kind of it needs to be borderline photographic at times. So stocks versus options. Options, if you don't know how to trade options, you really should educate yourself because it's the biggest bang for the buck. It's the best capital efficiency, right? If you've got 10 grand in your trading stock, it's going to be very hard for you to make enough money to make a dent in your life, give you a little extra spending money, pay off bills, get you half out of your job, whatever it is. With options, though, like a 50% return, 100% return per trade, 20% return per trade, that's not impossible or crazy. That happens all the time. In stock, that's crazy, right? You're going to get that once in a blue moon. But options, that happens a lot. And your risk is predefined, right? It's limited to the premium that you purchase if you're long options, which is what you're going to do in the beginning. So you can't lose more than you bet. You don't even really need to put a stop loss in there if you've properly sized your position. And there is really good free education for options trading. I think there's a guy named Kirk Duplessis. He used to be a Goldman's options trader. He started this business online, I don't know how many years ago. I hope it's still running because I'm going to say it. I haven't seen it in ages. I think it's called Option Alpha or Options Alpha. And he's created this enormous library of educational videos that are free. I think you get slightly more if you sign up for whatever service he provides. But there's this huge beginner, intermediate, advanced library that he offers access to. If you have no idea what options are, how to trade them, you're walked by the hand through this. So you got that. And then Tasty Trade, Tony Batista and Tom Sosnoff, Liz and Jenny. These are all former SIBO floor traders and market makers. And they have, I think it's like a free TV show. It's like a web show like Benzinga Live here. And they talk about options all day. It's option specific. And again, an enormous library of free education. So that's low hanging fruit. If you don't know how to use it, go check those two out. They're good folks. And I mean, Saws and the Bat are like legends in this business. So you are getting it from, the top tier of options traders here who have long retired and just doing this for fun. On the stock side, okay, I'm an ex-equities trader. I hope all my Volarb guys that are watching appreciate my support of the options market, but I'm an ex-equities trader. That's kind of my specialization. So I obviously lean that way. but it requires a much larger capital base. If you are going to go that route, please don't go the day trading route. Nobody does that on the professional side. We're not like in and out on the tick level. It's just with your cost of trading, you're going to lose money doing that. Like close to close, yes. Momentum swing, absolutely, no question. I'm a huge fan. That was my bailiwick. But intraday, please don't do that. It very rarely works out. So there, I hope I covered it all.
Yeah, you did. You covered all the bases and in order and remembered all of them too. So extra points for that. But yeah, maybe next week for the Kaiju Kicker, we can kind of maybe extrapolate on that last point a little bit and break down the different types of trading versus day trading, swing trading, momentum trading, and why maybe professional traders or investors employ certain strategies and not all of them.
Happy to do so.
Awesome. Well, Ryan, it's always a pleasure to get you on. Guys in the chat, if you want to learn more about Kaiju, about the DIP ETF, I'll drop that link in the chat that you guys can check it out. Or, of course, just the ticker is DIP. Pretty simple enough. Ryan, thanks again for hopping on and looking forward to chatting next week.
Always a pleasure, Aaron. Thanks very much.
Yeah, always a pleasure to talk to you as well. All right, guys, that was Ryan Pannell from Kaiju ETFs. Again, the link is in the chat, ticker DIP, if you want some more from Kaiju. Some very exciting things with AI. Again, I'm very blessed that we get to talk to Ryan because he has infinitely more knowledge, not only about AI and about that side of the technology than I do, but also just in general about this professional side of trading. I'm pretty good at, I could speak for us retail crowd. I know I can do that, but Ryan, can be my go-to guy for the professional side. Speaking of, we do have some more guests today. I see Nick Brown hanging out backstage, and we also got my man Bruce. Bruce runs a pretty big Twitter account, Volume Leaders. I'll drop that link in the chat if you guys want to check it out. Nearly 10,000 followers. Bruce is posting different charts and different kind of analytical reports. So let's go ahead and bring Bruce on, talk to him about his account and his strategies. Let's give Bruce our special Zinger Nation welcome. Bruce, I know this is your first time coming on Benzinga Live, but when you come on Benzinga Live, you get a special treatment. We've got these fun little intros, so when we come back, we'll be talking some volume. All right, Bruce, welcome to Benzinga Live. How you doing?
Good. How are you?
I'm good. Well, thank you for taking time out of your busy day to join us. Before we get started, you want to just introduce us real quick to what volumeleaders.com is? What's the, kind of mission of the website and the Twitter account?
Sure. Volumeleaders.com is a site that I built. It's intended to reveal institutional positioning and then provide context around those trades. So the goal is to know when and where institutions are active. And then from that, you can better position yourself to enter and exit trades accordingly. So it's a good means of finding confirmation based on whatever strat that you use that institutions are actually deploying capital or taking capital away so that you can better understand when the market might turn, when a reversal might be pending. And so,
got it. So I'm curious. I mean, I'll pull up kind of an example from your, Twitter of some of the charts and stuff you post. So is basically, are you primarily only doing, stuff on the technical side, the charts and that's it? Do you know fundamental analysis?
That's correct. No fundamental analysis. This is just intended to identify when and where positions are active. So there's no component that seeks to learn more about a particular ETF or a particular company prior to that. It's just to understand where institutions are actually active.
So let's pull up on your from your Twitter. Actually, we've got a couple good posts here we can pull up, and then you can kind of just walk me through like what you're pointing out here and maybe what kind of the insights that a retail investor would be able to take away from this, kind of the tangible value. So SPY, I mean, this is just the S&P 500, a chart we look at every single day. I know for here, right here for entertainment purposes only. So this is saying 100K at 445.
Yeah,
Is this someone that bought some 445 calls that expire at the end of the week,
No,
or
this is not an options trade. This is just a dark pool trade. All the dark pool trades are highlighted, are colored orange, and this is actually a phantom print. So this is why I said for entertainment purposes only. Sometimes phantom prints can project future targets, and this popped up yesterday, and as you can see, it's disconnected from price. It was $5 or $6 ahead of where price was at the time. So some say that these things can be used to anticipate where a future target might be. So I just posted this because I thought it was interesting.
got it? And then another post kind of right below it that I thought might be interesting to look at this week. Nvidia, I mean, the company's getting ready to report earnings either tomorrow after the close or Thursday after the close.
I think it's tomorrow.
Tomorrow after the close. I mean, this one, I think it opened at like new all-time highs today before selling off a little bit. So with the dark pool trades, is it just basically there's an existing order out there and the price hasn't hit it? Can you explain to me, I guess, a little bit what the dark pool means?
Well, the dark pools are just private exchanges. So institutions are the only ones that can access these, and they can trade whatever they want, whenever they want. There aren't rules. And in this particular case, a very large trade came in intraday, and this was of size that you typically would only see at the close. And so I highlighted it and tweeted it because it shows that an institution either entered or exited with great size right at that point in time. And you can see, if you zoom in a little bit, that the rank is shown on that bubble, on that orange bubble on the right. That trade was ranked 86th largest of all time. And one of the things that I do is try and provide context to these trades so that rather than just knowing that a large trade may have arrived, you can know exactly how large it was, and you can understand perhaps when the last time a trade of that size executed and the conditions that came with that trade and so on. So this was large enough to be noteworthy. And what happened after that was that price shot straight up. It behaved as a large buy order. Price went up another, $20 into the close and then overnight. So this just lets you know a little bit more about what institutions are doing.
So why would an institution, I guess, buy shares through the dark pool privately versus on the market?
Well, there are a few reasons. One reason is because they want to disguise their actions. If they trade on the dark pools, it's a lot more difficult to detect what they're doing. A lot of times they want to just trade with large size without affecting price. So if you were to place a trade like that on the open exchange, it would have an immediate effect on price. But if you wanted to get your trade filled and it had, perhaps millions of shares in it, you might want to do that discreetly without price reacting to that trade as it's getting filled. So institutions will do a lot of work on the dark pools to be able to establish large positions discreetly and in a manner in which allows them to get their positions filled without price reacting while they're doing it.
But
these things take time to fill sometimes.
So is it like usually typically institution? I mean, only so many whatever is going to have 1.3 million shares of Nvidia to sell. So is it like Goldman buying from JP Morgan?
It can be, yeah. I mean, if institutions are the only ones that have access to the dark pools, but typically what happens is that the institutions will get the order filled from the open market or distribute back to the open market. So the trade only reports after the execution is complete. It might get filled in smaller pieces and smaller chunks, 1,000 or 2,000, 5,000 shares at a time up until the point at which the entire order is filled. And after that point, then it's reported. So we see the trades as they get reported, but we don't necessarily know how much time it took to fill it prior to the time at which it was reported.
Got it. I mean, so Bruce, how do you then, if you're tracking all these different, and here I'll pull up the website too for the volumeleaders.com. I mean, all these different, institutional trades. I'm sure you're not going out and just kind of following each and every one. No. I mean, so it's I think a cool indicator to like see these trades and stuff, but then how do you take that data and then use that for your actual trading strategy, if that makes sense?
So what I do is I have a scanner or a couple of different scanners that will look for these disproportionately large trades and present to you the context that comes with it. So if you pull up if you scroll to the left there and look at that image on the upper left and click that, if you click it, that'll expand it and you can read the actual text. But that just shows an instance where IWM had two very large trades that came in, and the scanner will alert me to the fact that a trade has arrived. And then once it tells me, then I can pull up a chart and visualize it, and I can see, well, we had a steep decline there, and then a very large trade. It ranked 80th of all time. And then there's other context that comes with it. It'll tell you the last time a trade of that size came in, and so on. And I could surmise from that might be a buy because it came on a steep decline. I would then go look at my strat, which involves Keltner channels and other things, and try and ascertain the intent of the trade. And if I could conclude that that was a very large buy order, I could then use that as the level against which I could define my risk. And I could know that if price trades above it, there's a better than average chance that that's a buy order. And then I could know that if I wanted to take a long position, I could stop out if price broke back below that. So if an institution is positioned there with a lot of size and I can know that they're going to defend that position, then I can try and trade it accordingly. And I'll know exactly where my stop loss is. I'll know when I'm wrong, and then I can get out if I have made the wrong trade. But if I made the right trade, as you can see here, and I went long in this exact spot, you can see that it traded quite nicely for the next 2 or 3 weeks before we saw a different trade up there towards the high, which suggested that the longs that they established below were being closed. So I can know better when to enter and exit positions if I can follow institutional positioning, and I can understand where my risk can be defined and what levels are good areas to monitor for a potential trend reversal.
Got it. So when it says 80 and it says the 80th largest, or that means the 80th largest trade of all time, is that for the particular ticker or just in general?
Yes, that's for that particular ticker. So there are 5,000 or so tickers in the system, and each trade that comes in is ranked against all of trades for that particular ticker. So for the entire history of IWM, that was the 80th largest trade, which is significant. And one of the goals of volumeleaders.com is to identify these disproportionately large trades so that I can know exactly where institutions are really trading with conviction.
Got it. And I mean, I think that makes sense, in terms of, like I said, like you get all these signals. It's not like you're going to go out and follow it every one, and probably wouldn't be a great strategy if you did, because a lot of times some of these institutions or funds, they make losing trades too, and sometimes they don't outperform the market. So, but if you see a disproportionately large one, and then you kind of run it through some of your other screeners and other things, and it aligns, then hey, like, yeah, I mean, like if I was already looking to go long a certain stock and then I saw there was a disproportionately large trade of someone buying that stock on the dark pool, then it might help me say, okay, it's time for me to get in as well.
Yes, it can give you great confirmation. I mean, positioning is an important part of this, and it doesn't matter what strat that you use, because institutions are the ones that push price. So you want to know when they're getting in or getting out. And it doesn't matter what strat you might like to use. If you have an idea or you have a particular thesis in mind and you don't see that institutional positioning, it might suggest to you that maybe you don't want to make this trade and that maybe it isn't the right time to get in or get out. But if you do have a thesis and then it's confirmed by the positioning, then that gives you the confidence to make the trade and perhaps have a greater success rate.
That makes a lot of sense. Well, yeah. Bruce, is there anything else you want our audience to know about Volume Leaders? I mean, I'm going to drop your Twitter in the chat so folks can, follow you there. And I know you can register for free on Volume Leaders to get a lot of these signals for a select few tickers. And then, you can register to get the remaining tickers as well.
Yeah, so 7 days free for everybody if you want to give it a shot. There are lots of different subscription options that range from as low as $10 up from there, depending on how many tickers you want. But it's always free. There are always 12 tickers that I provide for free. So if you want time to understand the platform and watch the trades and see how it all works, you can use it for as long as you need to until you're ready to actually subscribe. Once you subscribe, 5,000 tickers, tons of context, tons of charts, visualizations, all sorts of interesting metrics that help you understand a little bit more about where institutions are active and what they're doing.
Beautiful. Well, Bruce, it was great to have you on for the first time on Benzinga Live. Great to meet
Thank
you
you.
and learn more about volume leaders. Hope to have you on again in the future. If you have any updates or things you want to talk about, maybe you can just ping me now on Twitter, email, whatever. If there's something, say
Yeah.
like, oh my God, this is the 15th biggest trade I've ever seen. I want to come on and talk about this. Let's do it.
Okay, sure. Sounds good.
All right, Bruce. Well, enjoy the rest of your day, and we'll chat soon.
All right. Bye.
All righty, guys. That was Bruce from Volume Leaders. Again, check that out. You can follow him on Twitter, of course. That's still free. You can still follow someone for free on Twitter now. I don't know if Elon has plans to change that or anything, but yeah, you can follow Bruce for free on Twitter. You can register online. Again, there's a big handful of big ETFs and tickers that you get free alerts on, and then you know, like Bruce said, a number of different subscription prices that you can pay if you want more tickers on top of that. But definitely a very cool service, something that I mean, as a retail trader myself, I'm trying to learn and use more of these signals from the professional institutional side in my trading and investing. All right, I see my man Nick Brown hanging out backstage. Let's give Nick our very special Zinga Nation welcome, and when we come back, we'll see what headlines Nick's been watching. Nick's been scouring the web deep and far today to find you the biggest Wall Street headlines, market moving headlines, news that moves. Without further ado, downtown Nick Brown. Nick, how you doing today?
I'm good, AB. How are you?
I am good. Good to see you. What's new? What's the haps? What's happening on the headline front? What's happening on the newspapers?
We've had a lot of earnings. We still have earnings. We had Zoom earnings. We have Lowe's, Dick's Sporting Goods. We've had a lot of earnings, and we have NVIDIA that's going to be reporting Wednesday night, and that is the talk of the town, AB. I mean, everybody has been highlighting NVIDIA earnings, and then we have Chair Powell on Friday at 10 a.m., like 10:05 a.m. Eastern time. He'll be speaking at Jackson Hole. So there's a lot to get to and through still this week.
Got it. Yeah, I saw Dick's stock was down. Dick's Sporting Goods stock was down 23% today. Do you have any color there?
Yeah, earnings weren't that great. EPS missed by a whole, almost more than $1 almost. EPS came in at like adjusted EPS $2.82. Estimates for $3.81. Sales $3.22 billion. Estimates for $3.23 billion. Comparable store sales increased 1.8% versus 5.1% year over year. Like, that's the only good news in this company because they're lowering their full year 23 guide to $11.50 to $12.30 from $13.50, and they see comparable sales flat to plus 2%. So the color and commentary regarding Dick's, why they're missing, why they missed EPS, they said there was a shrinkage in inventory and thefts. A common theme that we've been seeing is thefts, but a shrinkage in inventory is something that I wasn't expecting. I thought we were going to have a buildup in inventory.
Well, the shrinkage verbiage, or that wordage, how they're phrasing that, that's what they're referring to the theft as. So you'll hear, the shrink. It's basically a way for them to make it sound a little bit nicer than saying, hey, people are stealing a bunch of shit from our stores. They're saying, yeah, we ran into some inventory shrink problems. I've got an article pulled up here. The reference to shrink is the first that Dick's has made in an earnings call or press release for nearly 20 years, according to FactSet. So yeah, I mean, let's see. It says our Q2, this is a quote from the CEO, Lauren Hobart. Our Q2 profitability was short of our expectations due in large part to the impact of elevated inventory shrink, an increasingly serious issue impacting many retailers. So basically saying, hey, inventory is shrinking, not in the good way in terms of people are buying so many goods, but our inventory is shrinking in terms of, hey, we had, 100 NFL jerseys to sell, and now we've only got 90 because 10 went missing. And there's could be from theft, could be from internal issues. So Dick's does not seem alone in retailers warning about that issue right now. It doesn't sound like, from don't want to extrapolate too much from that, but it doesn't sound like great news for the overall economy if people are kind of stealing stealing more. So we'll see.
It's also interesting, AB, because I just did a quick search here. Like you can, I don't know if you know, but not many people know this, but you can search Control F on Windows. Is you can search for a keyword on the page, and I searched inflation really quickly. They don't mention really anything about inflation is higher, lower. Inflation is making people not want to buy things. Mostly it's because of shrinkage, inventory shrinkage, and that is like a keyword because we've seen from Lowe's, we've seen from Target, that we've seen from these other retailers saying inflation is a problem, that prices are still high and they have too much inventory. Here, Dick's is the opposite. They're seeing a lot more impact on this craze of just people stealing, and they're not getting penalized for it. There really isn't like, hey, you stole something, you're going to go to prison. They're not getting penalized for it. It's like a free for all. They're basically telling you, hey, go out and steal and you're not going to get caught.
Yeah. And I mean, other, I think retailers have, Walmart in the past has talked about, its loss prevention systems and basically from a cost perspective for depending on what the companies want to do. For Walmart, I know there were certain points where they're like, okay, we know X amount of merchandise is getting stolen a year, and we're willing to just eat that because it's going to cost us more to hire more security, to hire the right measures to prevent that. So, for example, I'm just going to make it obviously for Walmart's going to be way bigger, but if you're running Walmart and Walmart's losing $50,000 a year to stolen goods, but it's going to cost you $70,000 a year to fix that problem, then maybe it's not worth it. But as that number increases, if the amount of stolen goods is increasing, then eventually it's going to cross that threshold where then it is worth it for the companies to do something about it. So for a long time, people have, kind of, I guess, like, gotten mad at companies for basically having those policies that, just let them go, whatever. But that's just how the free market works. If it's better for the bottom line for companies to let that happen, then that's what they're going to do. So the companies don't have any, big, great type of obligation to society, to anything. Their obligation is to their shareholders. So until they're getting hit on the bottom line by the issue of theft, that's when they're going to start taking it seriously. And so it'll be interesting to see how Dick's Sporting Goods and other retailers start to try to kind of, I guess, fight back against this issue. I wouldn't be surprised if we see different types of security measures in stores throughout the next couple of years.
Yeah, and Lowe's was a different take. They reported better than expected earnings, EPS 456, estimates for 449. Sales came in just in line. They missed by a smidge, 24.96 billion, estimates for 24.99 billion. They affirmed their 23 outlook. They see full year revenue 87 to 89 billion, above expectations. Expectation was about 88, so basically in line there. EPS 1320 to 1360, estimates for 1338. And when I go to do the inflation look for Lowe's, what they say is basically that inflation is going to be impacting the customers. And they say, quote, in real disposable personal income, that could affect the rate of growth in consumer spending, inflation, and its impacts on discretionary spending and our costs, shortages, and other disruptions. They also mention inflation in the terms of energy costs, inflation or deflation of commodity prices. So what they're basically saying is what we've been seeing from Lowe's, I should say from Target, from Walmart, that yes, inflation is still a problem, but people are still spending. Consumer spending is still relatively strong compared to where many people thought that spending would come down. I mean, AB, I don't know if you saw, but Atlanta Fed is running very hot. Atlanta Fed GDP for Q3 as of last week was at 5.8. That significantly continues to tick up. Before it was at 5.1. Before that, I think it was 4.9. maybe 4.7, 4.1. It has significantly been moving upside. And all like the, I don't want to say earnings, but like inflationary data, retail sales, home housing data, all these different economic data points feeds into Atlanta Fed. And something that's interesting is that has been pointed out is normally inflation or the GDP data will spike. It will spike early in the quarter and then it will flatten out during the quarter. But 5.8 is relatively hot compared to where I think estimates are now, maybe 2, 3, maybe even 4%. But 5.8 is very hot, and we're not even halfway through, I don't think, or maybe we're about halfway through Q3. But I mean, that's strong growth, 5.8 right now.
Yeah, I mean, it will be interesting, I think, and you're seeing kind of, I think, a lot of investors become more worried about, these different things. And yesterday was really the first big green day we had in a while, and that seemed to be on the backs of essentially just two stocks, Nvidia and Tesla. Gearing up for Nvidia's earnings tomorrow. Have you been seeing any headlines about that stock, Nick?
Yeah, Nvidia did spike highest level, all-time highs at the open. It has since given back. We've just had a series of upgrade of price targets from different research firms. Right now, Rosenblatt has the highest price target of 800. HSBC goes to 700, I think, yesterday. This is just following the price target increases. This is something that a lot of people may get caught up in just because research firms are trying to chase the price target. This is something you shouldn't do just because we've seen what is happening, and we've had Tesla on a tear. Tesla's higher again. But I tweeted out last week a Magnificent Seven. So that's like the Apples, the Amazons, big tech, Tesla, Nvidia. A lot of them showed that they were down significantly 10, 11 days over a time period. But now we're starting to regain. And so here's the question is, everybody's waiting for NVIDIA. What happens if NVIDIA breaks the market? I mean, they raised guidance significantly last quarter. Will they be able to beat their own expectations? If not, what does that mean for not only NVIDIA, what does that mean for the market?
Yeah, NVIDIA's earnings on, tomorrow after the close, Nick?
Yes, and I was going to say, I'm just pulling up estimates for NVIDIA. If you give me a second, financial for, you can go to Benzinga Pro. Everybody can do this. After the close tomorrow, we are, according to Benzinga Pro, we are expecting estimated EPS of $2.09. And we have a revenue estimate of 11.22 billion. How does that compare to last quarter? Well, last quarter, that would be 524. EPS came in at 92 cents, and revenue blew past expectations of revenue came in at 7.19 billion. Estimate last quarter was for 6.5 billion. So we are significantly seeing a jump from estimated revenue last quarter, 6.5 billion, to estimated revenue of this quarter, 11.22 billion.
Yeah, I mean, I think like NVIDIA's earnings, you get these rare earnings reports where, I think like one earnings report for a single company will kind of act as like a make or break type thing for the market. If you recall, the last time NVIDIA reported earnings, the stock went up like 20, 30%, and it boosted the Qs up, I want to say 2.5%, 3% in a single day. And the reverse can happen too. I mean, if NVIDIA's earnings come in weaker than expected and the stock drops 10, 20%, you could see a bloodbath out there on the street in terms of tech stocks. So, it's just with how everything has aligned right now in terms of where the market's sitting at, with how much complacency, with how much uncertainty is out there among investors, seeing this report from NVIDIA will be the big, kind of make or break. If things are good, then I think people will see it as a buy signal, say, okay, we'll be fine. The market's going to be fine. And you'll see a lot of green. And the reverse is,
we also have Jackson Hole Friday. That's another major catalyst. Powell will be speaking 10:05 a.m. Eastern time Friday morning at Jackson Hole. And the question is his speech going to be longer than last year, 8 minutes? Sent the S&P down in a matter of time. But then you have to ask the question, what is he going to say? Is he going to reiterate inflation is still too high? Are they changing their goal? I mean, he's gone back, and there's headlines circulating through Twitter from last year, even this year. He says we are not changing our inflation goal. But the question is 3% the new 2%? Is 3% the new 2%? It may be, because inflation is so sticky that is the chair done hiking rates? I mean, how do you go about in this environment? Do you hike? Do you pause? I mean, Goldman's trying to pencil in 25 basis point cuts already through next quarter, starting in Q2 of 2024. I mean, inflation is sticky, but then you also have ECB President Christine Lagarde. She's speaking Friday at Jackson Hole at 3 p.m. Eastern time. Could that send U.S. markets down just because there's a different economy right now between U.S. inflation and Euro inflation?
Yeah, I mean, I don't think anyone should expect, Powell or the Fed to adjust inflation targets. And I think, honestly, I mean, anytime Powell speaks, it's going to be the big thing. But, like, I've gotten less and less excited, I think, to listen to him, because I don't think he's going to change anything he has to say. I think it'll basically, like, anyone who's excited to see Powell talk on Friday, let me just give you the gist of what he's going to say. He's going to say, hey, yeah, we've made some progress on inflation falling. We've still got some way to go. We're going to wait and see what the data looks like before determining if we're going to continue to raise rates or not. Like, he's not going to get, it's not like he's going to get up there and say, hey, we're done cutting. We're good. Inflation's gone. And he's not going to get up there and say, hey, well, I mean, like, that's what happened last year, Nick, is that he came up and said, hey, we need to, like, inflation's still an issue. Expect to see some pain in the labor market. I don't expect him to sound as hawkish. I expect him to sound pretty neutral. So
I don't need to listen to the speech on Friday. You kind of just gave us the rundown.
No, you should. You need to listen to it to let me know how wrong or right I was. Okay.
Okay, I will. I'm making note of it right now, putting it on the calendar.
All right. Well, there you go. All right. Well, Nick, it is 12 o'clock. It is noon. So time to wrap up the show. But you said you will be able to join on Thursday, correct?
Yes, we'll talk NVIDIA earnings, give you a preview of Powell. And, we have some IPOs in the market. ARM is trying to go public. They're listing under the NASDAQ ticker ARM, ARM. We also have a potential another IPO, healthcare software. Waystar is trying to do an $8 billion valuation here in the U.S. Remember, this is all during the market when IPOs aren't doing that great. So we're going to have to see how many IPOs we get from now till the end of the year.
Beautiful. Well, Nick, enjoy the rest of your Tuesday. We'll chat soon. Thanks again for hopping on with me today.
Thanks, AB. Have a great day.
Sure. All right, guys, that was Nick Brown, Downtown Nick Brown. Follow him on Twitter at News by Nick. It is noon here in Detroit, which means it's time for us to wrap up the show. Please smash the like and subscribe to the channel if you have not already. We will be back later in the afternoon with some Cannabis Insider and then as well as some live swing trading. Make sure to stay tuned. Be here or be square. Peace and love, y'all.